Okay, well, welcome to the class tonight. My name is John Mazzara. I'm with Remax Results. I've been selling homes since 1986, so a long time. Sold over 1,200 homes all throughout the metro area. I have a very extensive background in not only buying, selling, and investing real estate, but my wife and I had a mortgage company for almost 25 years. She's over at Wells Fargo for the past 11, and I have a financial planning firm as well. So I can bring a lot of extra information to the home buying process that, let's say, another agent, couldn't. So with that, I'm going to go ahead and share my screen and we're going to go through the PowerPoint. Okay. Can everybody see? Okay, I hope so. If you can't, let me know. So as a first-time buyer, do you feel concerned, stressed out, intimidated, anxious, or uncertain, not sure where to start? Well, I'm here to tell you you're in the right place. So tonight we're going to give you lots of information and we're going to cover financing in the process and point you in the right direction. Told you a little bit about myself. That's me. I work with Remax Results. The first 10 years of selling homes, I was with Merrill Lynch Realty / Burnett Realty, and then moved over to Remax, where I've been for the last 28 of my 38 years. You can Google me and find out more. You can go read my reviews. I'm happy to give you references if you ever need them. One of the websites that I want to give you, and you might want to grab a pen if you're taking notes, and write down mplsrealtor.com. And that's the website that compiles all the sales data from the North Star MLS. And the North Star MLS is our multiple listing service that services the Twin Cities. I'm going to call your attention to 3 lines. The first one is the median sales price. What we see over here is that in December of last year, homes were priced throughout the metro area and a little bit beyond at $350. This year, they're at $355. That's about a 1.4% increase. Now, when rates were very low, 2, 3, 4%, we were seeing homes appreciating at double digits, 10%, 12%, 15%. That's not sustainable. So one of the things that the Federal Reserve did is raise interest rates. They did that to control inflation, and one of the inflationary things was home prices. I would say they have succeeded. They have definitely slowed the housing market through rising interest rates because as rates rise, fewer people can qualify. The rule of thumb is typically 1% rise in interest rate means a reduction in your purchasing power by about 10%. So imagine when we were at 4 and then going to 8, somebody would have lost about 50% of their purchasing power. And we have a situation today where we have many people that have 2, 3, 4% mortgages because those rates hung around for about 10 years. And then what happened when they went up? The people that want to move can't because their incomes didn't increase to the same level that the rates increased. And therefore, they can't even afford at today's rates to be in their current home. So they won't be moving soon, which means they won't be adding their homes to the inventory that's available. At the other end of the spectrum, we have people that are downsizing, people that are maybe have too much home, maybe their spouse has passed or there's illness or the kids, no longer, they don't need the home, the family home anymore because the kids have moved on. So they're looking to downsize, but when they look around, what they're finding is that many of the homes that they want to downsize to are actually an upsize, which means they have to spend more than their home will net. And many of them don't want to spend more than their home will net. So they're kind of stuck as well. Neither situation is really going to change in the immediate future, which means when you look under that last line where it says month supply of inventory, we're going to probably be under or around 2 months of supply for a long time. That means that there's not enough homes for the number of people that want to buy homes. And again, until interest rates get very low again, which I don't think is going to happen, or until the cost of construction becomes less, which again, I don't think is going to happen. I don't think you're going to see it budging much in the future. The other kind of interesting metric is if you look at percent of original list to sale price received, you see that it's about 97 to 99%. What that means is that the average home seller pricing their home properly will sell it very close to list price. And that's important for you to know because many times, if you have never bought a home, you may talk to somebody that bought a home back in 2008 or 9 when there was more flexibility because there was more inventory, and they may say, well, you can get 5 or 10% off. Well, what we see here is that you really can't. And so I want to, set the table appropriately so that you have the correct expectation and don't lose homes that otherwise you may have been able to purchase. In fact, today, for affordably priced homes, I would anticipate being in a multiple offer. And that means you're going to have more people competing, and the person that presents the best net and the strongest financing to the seller is generally the winner. I have a young couple I'm going out with again on Saturday. This will be our, I don't know, maybe eighth or ninth time out. And we effectively have lost on 3 homes because of multiple offers. So just to prepare you for that, that is part of the process. We are in the spring market. We started earlier. The spring market started earlier because of this tremendous weather that we had up until a day and a half ago. But I understand the weather is going to be nice again this weekend. But the weather encouraged people to get out and look sooner. Normally, the spring market starts in March and runs through June. That's the busiest time as it coincides with children leaving and getting into schools. And a child doesn't generally want to move school districts anyway during the school year. So the parents put the home on the market later in the spring so they can time that, coordinate it with school ending. So this is the busiest time coming up, and we're already in that, and that should go for the next few months. So what are the steps to home ownership? Well, the first one is to go to a class like this, and some of them, depending on the financing that you choose, will have a requirement that you take another class like this that's up to 8 hours. Some of it's online, some of it's in person. So be prepared if you want to take advantage of the down payment assistance programs. Many of them want to make sure that you succeed as a future home buyer. In order to do that, they want to make sure that you have all the knowledge that they can possibly give you. Typically, there are 3 types of loans available to you. Conventional is available to everyone. VA is available to veterans, and FHA is available to everyone. And there are different degrees of, I'm going to say, stringency with regards to qualifying both on credit and in terms of the collateral. Conventional loans typically have a little higher credit score requirement, and they're a little looser on the collateral, whereas FHA allows for lower credit scores, but they are a little tighter. They look at things like the roof, flaking paint, and the functionality of windows, whether they stay up, for example, much more so than a conventional loan. VA also is very picky, and VA again is just for veterans. A lot of times you can pair a traditional loan with down payment assistance. And down payment assistance can be used for the down payment as well as for closing costs. The Minnesota Housing Finance Agency, for an example, allows you to buy a home with as little as $1,000 of your own money. So if you can come up with $1,000 and have a 640 to 650 credit score, you're going to be eligible for that program, depending on your income. And the first step to the home buying process is to get pre-approved. Once you're approved, then we can set up the search for you through the MLS and take you out and show you homes that meet your criteria. So first step, let's get you the financing. Let's get you through the home buying mortgage part of that process. Then we go out and we look at a home. When we make an offer on a home, we need to have a pre-approval letter. No seller will negotiate with you or even look at your offer without having that letter. So that's why it's the first thing that we do. Now you can use any lender that you want, but not all lenders are created equal in the sense that not all of them are approved to do down payment assistance. Some are, some aren't. And if you happen to talk to the wrong lender, you may never know about a program that could have benefited you. I had a couple of years ago that went to a credit union that they had been banking at for many years, and they got pre-approved there. And I told them, well, you qualify for down payment assistance if you want to use it. And they didn't want to use it, and they needed to save up a little more so they could cover the down payment and the closing costs. And so they were actually out of the market for almost a year. Well, that year, homes went up by 10%. So effectively, that costs them an extra. They bought a home for 300 grand. So by being out of the market for a year, that costs them at that time another $30,000 when they didn't need to. They could have switched lenders. So one of the things that I'll help you do is figure out which lender and program might be right for you. And I can provide you with a number of them that you can speak with. So I can help you with that, although I won't be doing your loan. I can help direct you to the right people. Once we purchase a home, you'll probably have a home inspection. If you buy a condo or townhouse, you'll get to review the rules, regulations, and bylaws, and you have 10 days from the receipt thereof to decide if that's something you can live with. Um, Again, once we've gone through those two things, then the next step is to order the appraisal and they order the title work. So you may have to get free and clear title, which means a home free of any former encumbrances from the previous owner. Your loan is finalized and then submitted for final approval. And then we go to the closing, you sign papers for about an hour. And after that, you get to decide what holiday party you want to host. So mistake number one is ignoring the first-time buyer incentives and programs. All of the programs, or I should say all of them, most of them will work with most conventional loans, which are underwritten by Freddie Mac and Fannie Mae, as well as FHA. And some lenders have their own proprietary conventional loans. So US Bank, Wells Fargo, some of the other larger banks, some of the credit unions will lend their own money under their own guidelines. And typically they'll also work with the first-time buyer programs. An interesting thing in the MLS, under the actual listing itself, there's a link that we can click on that says that this home is eligible for these programs. And then, of course, you have to meet the guidelines of those programs, but we can tell you right away which programs might fit for that particular home if you're looking to utilize down payment assistance. In general, a first-time home buyer is somebody that hasn't owned a home within the last 3 years. Many people think, well, I bought a home 10 years ago, then I got a divorce, then I rented, or whatever your situation, or you were foreclosed and then you're out of the market. If it's been over 3 years, you're considered a first-time buyer. I just mentioned earlier, one of the questions that was asked earlier was, will I need to do some extra education or complete a class and get a certificate in order to be eligible for down payment assistance? And under most cases, the answer is yes. And usually it's about 8 hours and they can be done online or in a classroom. And you want to get those classes done before you start the process in general. The reason being is that it does take 8 hours. And imagine if we're right in the heart of the home buying process and now you got to find that time. You can, but it's just more difficult and of course more stressful for everybody. So it's best off once you figure out what type of financing you want to use and the lender that you're going to use, that you go ahead and take the home buyer class so that you have that certificate in hand. And normally they're good for a year, so you don't have to worry about it expiring. Okay, first-time buyer programs can be city-specific, county-specific, or statewide. 99% of the time, they are dependent upon your income, and they give preference, generally speaking, for lower than the median income. However, there are some that are very generous, like the Edina one. I believe it goes up to $150,000 of income before you're not eligible. So don't assume anything. We need to have you find out the guidelines, and they're oftentimes family size dependent. So the larger your family, the more money you can make before you're not eligible. Everything, though, is dependent upon your credit. If you have poor credit, that needs to be improved under pretty much all circumstances to be eligible for down payment assistance programs. Now, FHA, it is conceivably possible that you could get a loan with as low as a 500 credit score. However, that's the exception, not the rule, because many lenders have overlays of which they require a higher credit score. Typically speaking, you're going to see a 640, 650 score under most cases with the down payment assistance programs. And FHA, if they do go down with that lower credit score, they are going to require a larger down payment of at least 10% and sometimes in excess of that. If you've had bad credit, they're looking for a reason that's reasonable. For example, maybe you didn't have health insurance and there was a situation that puts you in a bad spot, a medical emergency, for example. On the other hand, if you're a regular down at Mystic Lake and you have bad credit because you're gambling away your paycheck, that's not going to be an acceptable reason. Some of the down payment assistance programs are forgivable at certain percentages if you live in the home. So let's say 10% per year over 10 years, for example. And some of them just may outright be a grant. So some are loans, some are grants. There's many different types out there, and some are stackable. I have a loan officer that did 4 loans for an individual that bought in Minneapolis. It happened to be in an area where there were a number of programs that could be utilized. And that particular loan officer was diligent and did a lot of research and helped this. It was a single divorced mom buying in North Minneapolis, and they were able to stack all these programs up for her, and now she's a homeowner. So there's a lot of things that can be done if you have, again, the right people on your team. Here's an example of how you might use the Minnesota Housing Finance Agency down payment assistance program. So let's say you wanted to buy a home for $250,000. You might finance $242,500. You're going to need the difference between that, which is 3% as a down payment, and you're going to have closing costs of about 2.5%. Total amount is $13,750 that's required. However, you only need $1,000 of your own money, and you can borrow at the time of the purchase a second one and close on a second mortgage for $12,750. So you have a loan with MHFA for $12,750 and a loan with Fannie, let's say Fannie or Freddie, which are the conventional quasi-governmental agencies, for the other $242,500. So out of pocket, you're only into it for $1,000. So don't let money be the impediment to home ownership. Credit might be, and the good news regarding credit is that bad credit doesn't last forever. Many people don't understand the importance of it and make a mistake, pay late, whatever it might be, or have a bump in the road. The longer you live, the more bumps in the road you're going to encounter. The good news is you can come back from that. Typically speaking, anywhere from 2 to 3 years, assuming that you've reestablished positive credit, you'll be eligible again for a home. So we want to get you on the path to establishing credit. And sometimes when people, let's say, have a bankruptcy, they won't apply for credit again. That's not what you want to do. You definitely want to reestablish credit, maybe through secured credit cards, but you want to get credit history. And the only way to get a credit history is to reestablish credit. And if you can't get credit, you can always get a secured credit card or cards. You can get a secured credit loan and a secured credit card. Those are both advisable with regards to establishing trade lines, and the amount of credit is the amount of money that you put up. So I can give you some direction on that, and your loan officer can as well. So again, part of the process is to get into the process. So if you're not quite ready today because of a bump in the road, it doesn't mean we can't get you ready in a year. We're going to take the steps today to get you ready in a year so that we can start you down that road. Here's my lovely wife, Patty. So she is one of the lenders I work with. Over at Wells Fargo, they have a program called the Dream Plan Home, where you can get up to a $5,000 credit. And depending on where you work, as far as an employer, you might have an affinity credit as well. And or if you're in certain types of unions, there's a program called the Union Plan that also would give you a credit for that. So Patty is one person that you could speak to amongst many. Again, I work with a number of different lenders, mortgage brokers, and other banks besides Wells Fargo, such as US Bank. So there's a lot of different ways and people that I can make introductions to. I had mentioned the forgivable first generation homebuyers community down payment assistance fund. It's coming. It'll be here in April. So it's brand new. Not everybody will be able to offer it. So again, if you go to the wrong lender, you won't hear about this program, which would be unfortunate if you were eligible. So you need to talk to a couple of people. Um, if you're from another country, for example, and your parents never owned a home, this is something that you could take advantage of. So it's a way to expand home ownership uh, for people that maybe have never owned a home in their family. We're trying to create more homeowners throughout the state. This isn't just the Twin Cities. I'd mentioned the Edina program. So you could Google "come home to Edina" and call up Stephanie, or go online and you could see the program that they have for Edina. And you see down at the very bottom where it says first generation home buyer program, you can get an additional 20,000 on top of up to 90,000 if nobody in your family had owned a home previously, if you're always renters or something like that. So again, there's a lot of different things that are just tremendous to get you into home ownership. The types, I'm just going to cover these briefly again. A conventional loan, everybody is eligible for that. FHA, everybody is eligible. And a VA loan, only veterans. Underwriting guidelines vary per lender through what are called overlays, but they're fairly standardized. Now, the big banks here in the Twin Cities really aren't going to finance much less than a 620 score, and many of their programs require a higher score than that. But there are some lenders, and I have access to them, that will finance lower than that with a larger down payment. And again, a reason for why your credit score is low that makes sense. Unemployment or healthcare issues, for example. A conventional loan is a homebuyer's loan that is not offered or secured or insured by a government entity. Now, there might be private mortgage insurance. So if you don't put 20% down, then there is something called PMI, which is a monthly insurance payment that's paid with your loan, and that's to guarantee the lender that if you default, that there is some insurance to cover some of their loss. FHA and VA also are self-insured, meaning they charge you a mortgage insurance premium or a funding fee, but then they use that money that they collect to also help cover the loss should you get foreclosed upon. So that's why lenders like to make those loans, is they know that, typically speaking, the loss won't exceed the amount of the insurance. So they're always going to be able to come out of it whole, although they have to, go through or have somebody go through the foreclosure process for them. FHA is the Federal Housing Administration loan. They do require mortgage insurance that I just mentioned. It's called MIP. The good news is MIP just got reduced down to 0.55. It was up to 0.85. So the insurance under an FHA loan is less expensive today than it was just a few months ago. The benefits of FHA loans is that you only have to put 3.5% down. Now that's if you have a 580 or better credit score. If you have less than that, you have to put more down. The seller can pay closing costs of up to 6%. Now that's going to be difficult in today's market because there are more buyers than sellers. However, it's possible. So if you don't want to borrow the money from a down payment assistance program, or are ineligible and don't have quite enough money to buy the home and you need the closing costs, there's a couple of different ways to work that out. One is to ask the seller to pay them outright. Another way is to increase the sales price and then ask the seller for an equal amount of which the price was raised. As long as the home appraises, we'll be just fine. Low mortgage rates in comparison to others with an FHA loan, their rates are pretty good. And they allow, generally speaking, a higher debt to income ratio. Could be between 40 and 50%. There's something called automated underwriting, which means the computer, to some degree, makes the decision on how far the ratios can be expanded. And they take into things like income, debt, and other assets. And then the computer has an algorithm that determines, what is the likelihood of a default by you on that loan. And If the likelihood is lower, they let you spend more of your income towards a housing payment. With FHA, you can do a 15-year or a 30-year or an ARM, and you can always turn a 30 into a lesser amortization by paying more down on principal at any time. So if you ever feel like you want to shorten the life of your mortgage, you can do so by adding more to principal. FHA works with down payment assistance programs and grants, but not all lenders will work or are approved to work with the down payment assistance programs. So if you work with a lender that is approved to work with down payment assistance programs at FHA, you can do it. If you work with a lender that isn't, even though the product allows for it, you won't be able to. Kind of a comparison chart. FHA minimum down payment 3.5%, conventional as little as 3%. Minimum credit score FHA can be as low as 500 with a very large down payment. Conventional, generally 620. Maximum debt to income ratio, it can be maybe up to 50% FHA, probably no more than 45% conventional. Loan limits have just been increased. I got to change that slide to 2024 because that's the year we're in. Income limits, there is no income limits on either program. Minimum out-of-pocket contributions, it depends. And the reason I say it depends is it depends if you're using down payment assistance in conjunction with one of those programs. It could be as little as $1,000 if you're utilizing the Minnesota Housing Finance Agency funding or another program that allows you to use their money in lieu of your own for the down payment and closing costs. The biggest impediment, oftentimes the reason people rent, is because they don't have enough for what they perceive as a required down payment. They may have been told from friends, well, you can't buy a home unless you put 20% down. That's 100% false. And that's what I hope I have conveyed throughout this presentation so far. It does not require more than $1,000 if you're eligible for some of the Minnesota Housing Finance Agency funding. Other ways to get money for a down payment, maybe a gift from your parents or relatives. That was the original down payment assistance program. Other people that you knew that would help. Another way is a 401k loan. You're allowed to take 50% or $50,000, whichever is less, out of a 401k, typically speaking. You'd have to check with your employer, but typically they allow for that. With regards to an IRA, you could take $10,000 out of an IRA without penalty to buy your first home. There's no penalty, but because you took it out of a qualified plan, you will have to claim it as income. And then there's always the option, in the right circumstance, of the seller paying your closing costs. Conventional allows the seller to pay 3%. FHA allows the seller to pay 6%. Now they may agree to pay 0%, but they're allowed to pay that much. And again, we can work with the purchase price and possibly increase it to offset what we're requesting. Here's what you cannot use for a down payment. Borrowed money. You can't go cash advance a credit card. You can't borrow it from a friend or anywhere else to go put for a down payment. And you can't have mattress cash. So there's something called money laundering, not that any of you would, but the banks can't take cash because if it can't be documented, they don't know the source or where it came from. My recommendation is if you do have mattress cash or undocumented amounts of money, that you want to introduce that into the banking system at a minimum of 2 months in advance of making your loan application, so that that money has some time to be aged in your account for a period of time. The bank typically is going to ask you for the last 2 months of bank statements, and they won't source it. So you want to get that money into the system and out from under the mattress if you happen to keep money that way. So the buyers or your eligibility is based on the underwriter's review of your history. They want to make sure that you have the ability to repay the loan. So do you have the income coming in to pay it? Your credit history shows your willingness to repay. So you might have the ability through the income, but you pay late or don't pay at all. And that's demonstrated with your credit score. And then we have the collateral, the home itself. The home has to be credit worthy, if you will, meaning you can't buy a home that's in terrible condition, because should the lender have to foreclose, they can't turn right around and sell it. They would have to invest money into rehabbing or fixing it. They're not in the business of doing that. Banks are in the business of lending money, not owning real estate. So they will not lend on a home that isn't collateral ready unless you're using a rehab specific loan. And there are rehab specific loans, both with FHA and conventional. So if you want to buy a home that's scratch and dent, for example, it's got some bumps and warts and some issues, we can direct you to the programs that would be useful for that. Okay, let's take a quick question and answer. If you have a question for me, go ahead and unmute and ask your question, and or you can type it to me in chat. And if there aren't any questions, I'll give it a couple seconds here. I'll give it a minute or so, then I'll continue. Okay, then I'm going to go ahead and continue. Mistake number 2 is not getting your pre-approval before you view homes. I won't actually even take you out and show you homes until we have that pre-approval in place. It's not a good use of your time or mine. So the best thing, again, is to get that lender portion of the process completed first, so that we're showing you homes that you actually could purchase if you wanted. And we've worked through any issues, whether it be credit or employment, in advance of starting the process. But when we take you out and show you homes, we want you to be ready. The pillars of mortgage approval are your credit, your income, and of course your down payment. Your pre-qualification will consider all of those things. And what I like to recommend is that you get approved for the maximum amount that you're eligible. However, you do not have to spend that. So for example, if the lender says you can afford $3,000 a month, and you say, but I only want to spend $2,000 a month, that's just fine. We will show you homes based on what you want to spend. However, if looking at homes for $2,000 a month and you find you're unhappy and you want to move it up to, say, $2,200 a month, and you're already pre-approved for $3,000, then that's easy to do. We don't have to do anything different with the lender. You don't have to go back and be underwritten. Your letter suffices. The other thing is that when we make the offer and we show the approval letter, if your letter says $300,000 and you're really approved for $400,000, if I show them the stronger letter, I think it shows you as a stronger borrower, and the risk to the seller is less. Some agents will have letters written ad nauseum every time they make an offer, and I think that's a waste of time, and they write it just for the amount of the purchase price. Well, what if the seller counters you? Now what? What if they decide not to counter you because your letter said you're only qualified for up to 300 when really you're qualified up to 400? So I think having the strongest pre-approval letter that you can get written makes you a stronger borrower, especially in a multiple offer situation. Okay, tips for loan approval. Well, communication. Call us, ask questions. We're going to coach you appropriately. Think of myself as the agent and the loan officer as the quarterbacks. We're going to help direct this football team to the finish line. You want to continue living at your current residence and paying your mortgage and rent. What they don't want to see is a change in how you're paying. They don't want to see an increase in expenses. You're being underwritten the way you are today. Now, right after closing, things could be different. You can change it. You can do whatever you want. But for the purposes of underwriting and getting you the home, you want to be stable and you want to have things remaining the same. So use your credit as normal. Don't make any large purchases. Keep working at your current employer, preferably, or at least within the same industry. So let's say you're a nurse and you're going to move from this hospital to that hospital, no big deal. But let's say you're a nurse and you wanted to become a self-employed business person. That's a problem because you don't have history in that new career. So stay with your career after you close on the home, then you can go start your own business. Same with insurance, and you're basically keeping everything stable during the underwriting process. You will be asked for documentation, so you're probably going to have to upload your pay stubs, your W-2s, maybe your tax returns. Um, if it's a 401k loan, documentation of that loan. There'll be different things that you'll be asked to, and the loan process moves as fast or as slow as you provide that documentation. You won't get your approval if it takes, I mean, you'll get it eventually, but it will stop once you stop. So you have to continually monitor your process and do whatever the loan officer is requesting of you. Things again to avoid are large purchases because that could change both your cash on hand and or your payment, the obligations. You don't want to have large deposits or change banks. You don't want to transfer balances around that will bring up questions. You also don't want to close credit cards. Many people say, well, I'm not using that card, I'll close it. But they may actually be harming themselves. The reason being is that your credit utilization, meaning the amount of credit that you use in relationship to the amount of credit that you have, is called utilization. So if you had $10,000 worth of credit and you used 5,000 of it, you're at 50% utilization. Now, what if you had two $5,000 credit cards and you closed one? Well, if you have 5,000 credit on the one card, then that's 100% utilization, which is much more risky to the lender because there's no room if you get in trouble. So you don't want to do any consolidations. However, you might be, during your process, recommended to go ahead and refinance your student loans to get a consolidated payment that's lower than you have now so that you can buy more house. That'll be something for you to discuss with your loan officer if you have student loans and how that might affect your process. Pre-approvals versus pre-qualifications. So you've heard, I'm sure, garbage in, garbage out. What that means is that you will be approved based on what you put in, but the approval says at the bottom of it, subject to verification. So if you say you make 100 grand and you really don't, you only make 80, for example, when the lender verifies it, they're going to modify your approval. That's why we prefer pre-approvals, which are actually underwritten versus a pre-qualification. Pre-qualification is a looks good, meaning we pulled the credit based on what you've told us for income. We believe you'll be able to complete the process. The pre-approval, on the other hand, is all of those things with the pre-qualification, but then it's gone from trust to verify. So pre-approvals, the underwriter is going to touch things, you're going to upload documents, and they're going to be reviewed. It takes a couple of weeks for the fully underwritten process to go through, but that's much better than doing the pre-qual. And same thing with the down payment assistance programs. Some of them will require that you take the home stretch or other frameworks type of education first before they'll underwrite you. And sometimes the money is reserved and set aside. Well, they can't reserve and set aside money for you until you've completed their requirements, which might be that education. Again, we want to do all of this stuff way in advance so that when we get to the home buying process, we're able to go ahead and actually do it. It allows you to shop with confidence with a pre-approval so that you know what you can buy. Your search criteria that I set up for you is determined by your letter and by what you tell me you can afford. Makes your offer real. Again, no seller will look at any offer, and we won't even write an offer without a pre-approval letter. It's just expected. It saves you time down the road and stress, and you can close quicker. For example, what if a seller said, you know what, I like your offer, but I need to be on the job in Florida in 2 weeks. I got to get out of here. If you can close in 2 weeks, I'll sell you my home. If you've already eliminated some of that underwriting procedure and process up front, you hypothetically could close in 2 weeks. Not that you're going to or want to, but for the right house, maybe you would. So again, getting all of this stuff done up front is so important. And there's fewer surprises. Who likes surprises? Who likes negative surprises? None of us. Okay, mistake number 3, picking the wrong lender. I've referenced this a few times, and choosing the wrong lender can be expensive and might prohibit you from buying a home when you could have. So not all banks work with or are approved for the use of down payment assistance programs. Typically, you're seeing the smaller institutions that have limited loan products. If you were to go out, for example, to the Minnesota Housing Finance Agency, they have a list of lenders whom they've approved, both in terms of banks and or loan officers. And you could contact any of them and start the process. Or again, you can speak to me because I have friends, that are in those industries, and I can direct you. Beyond my wife over at Wells Fargo, I would be happy to provide you a number of names of lenders that you can speak with. Larger banks and mortgage brokers often have more resources than maybe some of the very smaller institutions. Nothing against a smaller institution, but it's going to be much more of a bread and butter versus a smorgasbord. And so I'm going to encourage you to look at the smorgasbord so that you can be exposed to all of the programs. And that way you can pick what's right for you. I'd mentioned earlier that client that was very unfortunate. They had loyalty to their credit union at the expense of not buying a home for a year, and they lost out big time. So it's all about balancing your situation, meaning job, employment, and credit, with the right loan product, and then finding the right home. Is a 30-year fixed rate always the best? Not necessarily, but a 30-year fixed rate mortgage will generally be the lower payment other than an ARM. An adjustable rate mortgage is a 30-year loan, but where it's fixed for a period of time. It can be 3 years, 5 years, 7 years, 10 years, for an example. That'll be a little less expensive rate-wise generally than a 30-year fixed. But in both cases, those are generally going to be 30-year loans, not 15-year loans. And then we have the rehab loan. There's a conventional rehab and the FHA product. The FHA product is called the 203K. So if you do find a home that you would like to do some rehab on, you may be eligible for a loan right off the bat that allows you to borrow money to do some of those improvements. The FHA 203K comes in a light and a full version. The light version allows up to 35K of money and work to be done. The full K allows up to the FHA loan limit amount. And the full K is a little more involved. There has to be a construction manager in the process. And in both cases, there's bids that are required and a current value and a future value appraisal that needs to be completed. I'd mentioned some of the goodies over at Wells Fargo with some of their affinity programs where you can get extra, gift cards for $500 and other things like the Union Plus program that is specific to some of the union members, protects them against, getting foreclosed upon to a degree if they get laid off and have some problems. So there's that, plus some of the other credits that you can get. Your lender, whomever you choose, needs to be a loan counselor and not what I call a rate quoting monkey. Some lenders that are online operate out of call centers. And I think you can tell that this procedure is very complicated. And you want to work with an expert. You want to work with a lender that has some history, somebody that's been in the industry, not just recently introduced to it. Because the longer you've been into it, the more ways you can see how you can make a loan and home ownership possible. And some of the people in the call centers just don't have that experience. And since this is your first time, or maybe second time, you don't know what you don't know. And that's why you have to work with experienced people. Whether or not you work with me as your realtor or one of the lenders, I would recommend work with somebody that has some history and has some experience, because you will be able, you will have a much better experience working with somebody that's been in the industry for a while than somebody that's just gotten into the business, because it is complicated, and I don't want you to make the wrong choice because you didn't have the right information. Mistake number 4 is buying directly from a builder without realtor representation. So we're able to represent you with all of the builders that are advertising on MLS, which is all of the national builders. So the Pulte's, the Lennars, the D.R. Hortons, M&I's, for example, all co-op, which means they all allow us to represent you, as well as many smaller builders like Stonegate and Gagne and some of the other ones that are building custom homes that are again advertising through the MLS. What they all require is that we represent you on the initial contact and take you out. So you'll see the builders, the signs, come to the open house. Let us take you to that open house, because then we're able to represent you. And we're able, again, if we've been around for a while, to provide you recommendations on why, one builder is better than another, and why one lot might be better than another, for example. Okay, a question just came in. How do we determine a good realtor to work with, and are realtor commission rates a factor? Good questions. So in my case, I've sold over 1,200 homes throughout the metro in my 38 years. I have a history. I wouldn't have been in the business as long as I have been without having successful clients and references. And you can Google me and see. I would say picking an agent, it should be somebody that's been in the business for at least 3 years and that has a good number of transactions. I'm in the top 1% nationwide of production. In a normal year, I do about a home a week, either a purchase or a sale. And I don't have a team. I do that myself. So work with somebody, sometimes you see team members, for example, and the team has a leader that's experienced, and then they recruit generally inexperienced people to work on that team. If they were more experienced, they would be on their own. They wouldn't need the leads from the team, for example. I think that, and this is just my own personal opinion, I think that's a mistake, because you're not working with the team leader, you're working with somebody on their team. Sure, they can call the team leader, but you're not going to have that same experience. When I walk you around a home, it's basically like a pre-inspection. I'm pointing out all of the flaws and the reasons why and what you should consider in this home. And my buyers are continually thanking me for pointing all of that out. And I will dissuade you from purchasing a home that I don't feel is a good home. I don't need to sell you a home in order to pay my mortgage payment. That isn't necessarily the case with some of the other people. And so I want it to be right for you. And when it's right for you, it's right for me. I always tell people buying a home is like falling in love. You just know. And I'm going to help you make that right decision. So that's the first thing, is work with somebody that has been around. They wouldn't have been around if they didn't have a good reputation. And you can Google them and find that out now, or ask for references, or like I do have a nice thick sheet of references that I can show you. Realtor commissions. So most real estate agents are paid through a commission split with the seller. What that means is I get paid from the listing agent. So you don't pay the commission, and who knows what will change in the future. But as of right now, we're paid a co-op split through the multiple listing service, and whatever that amount is, that's what we receive. Now, could that change in the future due to some of the recent litigation that's out there? The answer is it may be structured differently in the future. But right now, that's how it works. There is an admin fee. So when you work with an agent, typically speaking, there's an admin fee. The admin fee is paid to the real estate brokerage at the time of the closing. It's part of the closing costs. They range from maybe $400 to $700. Ours is $599. So if you're successful in buying a home with me, the admin fee will be charged at the time of the closing as a closing cost of $599. That will change but it's fairly consistent throughout the industry. throughout most companies, whether it be Coldwell or Keller or Edina Realty, for example. They all have that admin fee. And so that hopefully answered your question. We can address that in more detail if not, and I'll continue on with the presentation. Okay. There we go. Okay, so the cost of buying from a builder is the same if you're represented by an agent. So if I walk you in and we fill out a registration form, or if you walk in with the builders, open house on a Sunday or something, it's the same. Doesn't cost you any more to work with an agent, but you won't have representation. The builder will be represented by the salesperson that's in the model home. I'll be representing you if I'm walking you in. And an agent can help you choose between builders and make different recommendations on lots, as well as what buyers are doing today with regards to upgrades that might add value. Should you buy the walkout lot or the lookout lot, or is 40,000 too much, or should you do a 9-foot ceiling upgrade? So there's different things that that I can bring to the table when representing you with a builder. And I think it's a better experience. And since it doesn't cost you any more, other than the admin fee, for example, I think that's worth it. And again, we're going to send you the list of all of the available homes when you set up a search, and that includes new construction. Okay, closing costs. So this is kind of interesting right now, and this ebbs and flows. Some of the builders will offer you incentives to use their lender. And sometimes it's a good deal. Sometimes they'll give you $15,000, $20,000 if you use their lender at the time of the purchase. And the reason they're doing that is they don't want to build a home only to have it fall apart because you couldn't qualify. If their lender says you're qualified, they believe it. If another lender says it, it might be true, it might not be true. So it all comes back to the strength of that lender. If a large lender says that you're qualified, you probably are. And if you've been underwritten, well, then of course you are, subject to you maintaining your credit and everything that was in the initial application. So a builder, though, doesn't like to have that extra risk out there. So sometimes they'll work with a lender to provide preferred financing and give you an incentive to use that. Sometimes it's a good deal, sometimes it isn't. That's where I'm able to help you make that evaluation. Let's see, a realtor can evaluate multiple builders and the financing and the other goodies that they might offer. And sometimes the builders will match. There's a development out west of the cities here where there's 2 builders, both of them are excellent, and they typically are matching each other. So they say, well, whatever that guy is giving you, we'll give you 2. And so sometimes a little bit of competition is where you win. And again, we're able to help you make that choice between the builders and weigh the different things. Mistake number 5 is skipping the home inspection. When you might need it, when you might not. Okay, first off, I'll never tell you to skip an inspection. That's going to be your choice 100% all of the time. But I'll tell you when people do and when they don't, and when it might be something that you want to consider. Again, it's always going to be your choice. Remember that an inspection becomes a contingency, because if you make an offer subject to an inspection, that means you could walk away. If I'm a seller and I've got 2 offers on the table and one has an inspection and one doesn't, it means that one way, without the inspection, I've sold my home that night. On the other hand, your offer with the inspection means I may never get to the finish line. And the buyer without the inspection might go buy another home, and then I'm left with nothing. So a seller will give more weight to an offer without an inspection. If you're buying new construction, I don't know that a home inspection provides any value, because you have the 1-2-10 builder warranty, and you have to get what's called the certificate of occupancy from the city before it can even be sold and closed. So when a builder builds a home, it's being checked throughout the process by different departments from the city. So there's a framing inspection, there's a foundation inspection, there's an electrical inspection, there's a plumbing inspection. And each of those times that an inspector's coming off, they're checking the work and they're signing off on it. The new construction is all up to code and signed off on. And then the final inspection from the city is a certificate of occupancy. Until that's been obtained, you can't close on the home because it's not a home. It's a house that doesn't have a certificate yet. So I don't know that a inspection from a private party adds a whole lot of value on new construction. However, let's say the home is old. Let's say you're buying an old home in Minneapolis or St. Paul that's 100 years old. Well, in those two particular cities, they do have to, as a seller, have to have a time of sale inspection report. That's more or less a disclosure. When you have a home inspection, you're going to get about a 50-page report, and you're going to learn all about it. And I call it your honey-do list, meaning it's things that you're going to be able to do in the future. If there's hazardous items, those are fair game, but you're not going to get the seller of that 100-year home to bring it up to current code and to rebuild that house. If you want that, then we need to buy new construction. You're going to be accepting a lot of things with an older home because it's just that, an older home. And some things that were code yesterday aren't code today. And it's not fair to require that the seller bring all of those up in the event that they were all visible and disclosed to you at the time of your purchase. So just know that if you're going to require those things, then you're not going to be able to buy a home. The seller is going to tell you no. And I'm going to be there to guide you appropriately on what I think might be reasonable and what not be reasonable. So I'll provide that guidance to you based on my experience. A question just came in. How much can I afford with a $90,000 household income? I'm going to give you a rule of thumb, but I don't know anything about your $90,000 income, if it's overtime, if it's salary, how you're paid. The rule of thumb, generally speaking, is 4 times your gross income is what you're going to be eligible for in the form of a mortgage. So you may have a lot of debt, which will affect that. Your income might be sporadic or with bonuses, and they aren't going to be able to utilize all of it. The answer, though, is roughly 4 to 1. That's typically what you're going to be eligible for. Okay. Now back to the inspections. So an inspection creates a contingency you may or may not want to have it. There are 5 types of inspections. There's the basic home inspection where you get that, 50-page report with pictures. It's $500 to $600. You might do an add-on radon inspection. It's another $150 to $200. You can do a sewer line scope inspection, about $250. You can also test for mold, another $250, and then have somebody look at the chimney and or the fireplace flue, another $250. So you can see very easily you could have $1,500 into a home with regards to inspections and then walk away, and then you're out that $1,500. Might be the best $1,500 you ever spent, meaning you avoided a problem, but just know that that's, if you hire all of the inspectors, that's about what it's going to cost. Most buyers will only do the 50-page report, and if something comes up from that, then do an additional inspection and or do the radon because it's cheap to have them do it at the same time. Now, if you're buying in Minneapolis or St. Paul where the sewer lines might be original, that might be very important to do for that $250, because if you discover something like a broken sewer line or a bad sewer line, although the seller doesn't want to fix it, they have to disclose it to the next buyer if you choose not to buy the home. So by default, you're going to be able to probably get some of that work done. The reason being, again, is because the seller, nobody's going to be able to buy that home with a failed or faulty sewer line. So that might be a hot potato you can throw back at the seller. However, I'll just mention one thing. If you hire somebody, let's say, that's in the sewer line repair business, what do you think that they're going to see? The need for a new sewer line. We might want to hire an inspector like a Ron the Sewer Rat, for example. He is a sewer line company, where they run a scope down there and then they give you an opinion. They're not in the business of repairing that sewer line, and they may not have a bias towards it. So I'm just putting that out there. Okay, the risks of skipping an inspection is that there's no recourse for you. So after you buy the home and you find out something is wrong with the home, you can't go back to the seller and say, I want you to fix this. Because if the seller didn't know, they weren't required to disclose it, and you're just out. It's your problem now. Why would somebody buy a home without an inspection? Well, they might have a very large knowledge of the home itself, meaning they're in the trades, or they have relatives that are in the trades, and so they feel very comfortable doing that. Or they want to make their offer more competitive and they want to buy that home regardless. They figure they can pay for the work if it needs to be done. Or if it's newer, if it's a newer home, everything is relatively new, and if it's within the last 10 years of being built, it may have some residual warranty under the original How 210 builder warranty. So it just depends. But if you don't have an inspection, it's on you, meaning you've effectively bought it as is, and there won't be recourse against the seller, unless the seller had knowledge, and you can prove it, of something material that should have been disclosed. And if you didn't, and if you had that knowledge up front, you wouldn't have bought the home. So for example, a water problem. The seller's basement flooded every spring, and they knew it. And you bought the home in the winter before everything thawed out. And they didn't tell you that they had a bad problem with water in the basement. You move in the spring and it floods. If you can prove that they knew, maybe the neighbors tell you, maybe you call up a water mitigation company like Service Pro, for example, and find out they've been out there every spring, you may have some recourse. But without proof, it's going to be on you. Okay, mistake number 6, skipping the condo documentation review. Based on your purchase, your ability to purchase, you may pick for your first home to be a condo or a townhouse. That's actually what I did. I'm in my 3rd home, but my first home was a condo over at Edinburgh. So it's a great place to start, and allows you to build some equity, and it's an easy form of ownership. Now, when you buy a condo or townhouse, you have 10 days to review the rules, regulations, and bylaws and the resale disclosure certificate. Your 10 days don't start until you've received all of the items listed. If one of them is missing, your 10 days have not begun. So it only starts when you get the documentation. So it's the seller's responsibility to provide those documents to you. And then you get to review them. If for whatever reason you decide you can't live with those rules, you can get out of the purchase agreement and get all of your earnest money back without any recourse or liability to you. You can shorten it by mutual agreement to 3 days if you agree. And sometimes the seller in a very fast or busy market will say, hey, I don't want to take my home off the market for 10 days. Here's all the association documentation. Please shorten it to 3 days. Tell me yes or no in 3 days. And that's not an unreasonable request, because if you can't get through it in 3 days, I don't know why, but if you couldn't, then that would be a problem. But otherwise, it allows the seller to mark the home as sold and to move on with their life, maybe buy another home themselves. And if you're not going to buy it, then they can put it right back on the market and not lose the momentum. So if you're asked to shorten it, and if you can read the documentation in that 3 days, that might be something that you're willing to do. That might be a negotiating tactic that the seller takes to accept your offer, is that you agree to shorten your timeline. What does a search look like? Well, once you're approved, then we go in and we set up the search, and we click on the buttons over here to the left. You see the coming soon and active. And then we build the minimum requirements. You can see over on the right where it says property info. We pick the price range that you're qualified or want to remain in. And then we put the minimums. So for example, let's say you're open to a 2-bedroom. You really want a 3, but a 2 would work. And we're going to build it off of a 2-bedroom or more search. Same with bathrooms. You'd like 2, but 1 would work. Same with garages. So we pick the minimums, and then we build your search, and then we set it up for you so that it's delivered to you on a daily basis immediately once it's listed. So it's an ASAP search. That way you're up to date. And there's no harm in looking. It's free to look online like this. So I would encourage you again to get the financing in place. Let us build the search, watch the list, and when a home or homes meet your criteria that you want to view, we'll go out and take a look. And then because you're pre-approved, you're ready to go. You can go ahead and make an offer should it be the right house. I have many, many, many resources for you. One of them would be a flip book. Now, if we meet, I can send you or give you a hard copy of the book. And it's Secrets for Successfully Purchasing Your Home. It's some of the things we covered tonight and beyond. So how do you feel now? Are you excited, confident? Do you feel informed? Are you ready to get going? Well, I would say take your flip phone out and take a picture of this website. Oh, we have a chat coming in, a question. Okay, Raina says that she feels better informed. That's excellent. If any of you do have questions, again, feel free to unmute or to go ahead and type me a message in the chat and I'll address it to everybody. I'm glad, Nang, you feel informed. That's great. Same with Akoi. Excellent. So the next step would be to book an appointment. So you could go on, pick a date and time, and then I'm going to confirm that with you that that will work. And if it doesn't work, we'll pick a different date and time. Okay, and we can meet again through Zoom or in person. I work out of multiple RE/MAX results offices, and we have offices all throughout the Twin Cities. So getting you again with a lender or under a proper program will be our first steps. Oh, we have a question. Massive has a question. Yes, Massive, how can I help? Okay, you have a question regarding if you have, I'm just waiting for the question to be typed in here. Okay, if you have less than 20%, that's not going to be a problem. Remember, we can buy a home with as little as $1,000. And depending on your credit, some of the conventional loans allow for a 3% down payment. FHA is 3.5%, VA is 0. And if you buy in a rural area, like I just had a listing in Buffalo that sold, and that qualified for rural development. If you're outside of the Twin Cities, there's a rural development loan. We didn't even talk about that tonight. That allows for 0% down as well. So there's rural development as well. So your question is, if it's less than 20%, is it necessary to pay loan insurance? The answer is yes, but maybe no. What I mean by that is you may not have 20%. However, the down payment assistance program that you're using created the 20% because you're borrowing enough. Like let's say the Edina program with $90,000, that might represent the 20% down, and therefore there is no mortgage insurance. So if the down payment assistance program provides 20% or more on a conventional loan, then you do not have mortgage insurance. With FHA, you do have mortgage insurance. And whether or not you have it for the lifetime of the loan, which you typically do with FHA, depends on the down payment. On a minimum down, it's going to stay on that 0.55. With more than 10% down, it might fall off after 10 years. So the answer is it kind of depends. But the down payment assistance programs do count as a down payment, and therefore you may not have the mortgage insurance on a conventional loan, or you would have less of a cost associated with that private mortgage insurance because of that down payment from the down payment assistance program. Okay, are there other questions? Okay, so making it happen is a two-step process. We're going to set up another time to talk individually about your situation. We're going to book an appointment. You can do that online, and then we can either meet in person or we can meet, um, uh, through Zoom or however you want to do it, or on the phone. Question came in again. Can you name some of the good lenders for pre-approval? Well, I think Wells Fargo does a wonderful job. They have underwriters, for example, that they pay. Their employees of Wells Fargo. So if you want to get fully underwritten at Wells, they'll do that. If you work through some of the mortgage brokers, they don't have underwriters, not all of them, but some of them don't have underwriters on staff, or they have to pay what's called a contract underwriter to underwrite. So they don't like to pay, let's say $650 to an underwriter, only to have you not get the loan through them. So some of the smaller shops, some of the smaller banks don't want to do fully underwritten loans. They'll do an automated underwriting, meaning that looks good, but they don't want to spend the money on a file that may never close. And you can understand that because that's a real cost. That's the problem with some of the smaller lenders. Wells Fargo also works with the down payment assistance programs. US Bank works with like 40 different programs as well. US Bank is the servicer for the MHFA loans. So regardless of where you might get your MHFA loan from, it's going to be serviced through US Bank. So US Bank is one of the lenders that, like, for example, did the Rondo program for my buyer over in St. Paul. That was specific to US Bank. Not all lenders could do that. So it depends again on where you're looking to go, but I think that those are two good options, as well as some of the different brokers like Movement Mortgage and Nations Lending and CMGI. So there's all of those lenders I have relationships with, refined. There's a number of different programs, products, and lenders that I can make introductions to. Do you have 15 or 30-year mortgages? Yes. Most lenders will underwrite you for a 30-year loan to start because that has the lowest payment, which allows you to qualify for the most amount of mortgage. You could start off with a 15-year mortgage if you wanted right off the bat, but you can't turn a 15 into a 30. So if you get in a bind, you lose your job, whatever, you have extra expenses, and you want to flip over to a 30-year loan from a 15, you can't. But you can pay extra on a 30 and convert it to a 15. That's why starting with the 30 gives you the most amount of flexibility. So I would start there if it was me. Any other questions? Question, do you have a company people that are interested in commercial property, like a multi-unit or apartment building? The answer is yes. However, that's not going to be for a first-time buyer. You can't buy over a 4-unit as a first-time buyer and live in it. You can't go buy a 5-unit or a 6-unit or whatever. But FHA will finance multifamily up to a 4-unit with 5% down. Fannie and Freddie will now do 5% down on multifamily as well. That's huge. They weren't doing that. Now they are. Duplex, you can go in with 3.5% down with FHA. So if you want to buy a multifamily, which is a great way to start, you can do that with high leverage with FHA and now also conventional. But you're going to be limited to up to a 4-unit. Anything over 4-unit is commercial. And again, I do have those resources for you, but my guess is if you're a first-time buyer, that you're not jumping right into buying investment property. Any other questions? You're welcome on that question. Okay. Let's see here. So when you click on the book a home, if you take a picture of this, you're going to pick a day and a time, and then I'm going to confirm that with you that works after I get notice that that's when you'd like to meet. We want to help everybody. So regardless, if you have a citizenship here or you have a green card, we can help you. So there are some programs for some people that are on visas, certain types of visas, that are eligible to buy a home. Some people have ITNs, so they don't have a social security number. There's loans for those individuals as well. So we want to try to help you wherever you are at in the process of becoming a citizen. You might not be eligible, but you might be, and I can direct you to the right people that can tell you what you need to do so that you can be eligible when you're ready, meaning when your visa or your status allows you to be. If you want to take a picture of this, I have a survey, a 7-question survey, and then you can pick a travel certificate, a dining certificate, or a hotel certificate if you take the survey. Now, there's costs involved if you activate those certificates, but they're a good deal. And it's just you get to decide which one you want when you take the question, when you take the survey. So I'll leave that up for a second. If you want to take a picture of that QR code and go out to that site, you can do that. And then here's a picture of my business card if you want to take a picture of that so you know how to reach me. And that is what I have for you this evening. Unless there's no other questions, I'll stay on as long as you have questions and answer them. Oh, you're welcome, Nang. Thanks for coming. Thank you, Massa, for coming. Again, don't keep me a secret. Share my information. I am going to send everybody a copy of this once I stop recording. So tomorrow, everybody will have a copy in their email. And you can watch this again or share it with somebody. It will be, I haven't decided if I'm going to make it private or put it on my channel. I have a YouTube channel where I interview different lenders and different programs that you might find very useful. That is also, you just go to YouTube, type in my name, and it'll come up my channel, and you can watch all the videos you want. We have a question, are H-1B visas eligible for DAP? H-1Bs are eligible for a mortgage. I'm not sure about all the DAPs. That's where we're going to get you with the lender. And the lender is going to tell you specifically which DAP you're interested in to the degree that it might be eligible. Some might be, some might not be, I guess is what I'm going to say right now. We would have to get you with a lender on that. Any other questions? Okay, well, I look forward to working with you all now or in the future. Thank you for attending, and I'm going to go ahead and close this out for tonight. Have a wonderful evening.